Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about a potential shadow Fed president and how housing demand is trending as we enter May. I want to thank our sponsor, Rocket Close, for making this episode possible. Logan, welcome back to the podcast.
Were you just dealing with a tornado?
Well, I don't think it was an actual tornado. It was a really big storm. So we all of a sudden had winds that were like 60 miles an hour. So I was on a call and I'm sitting here talking, and then I look over and I'm like, I have to go because things were like flying by the window that should not be flying by the window. But I don't think there was a tornado. But yes, it is spring in Texas. This is what happens.
You know, the most drama that we have spring in Irvine, California is watching two squirrels go at it over a nut. That's about it.
Well, you know what? Your wildfire, earthquake, I mean, you have some stuff. It just may not be happening right now.
We have some stuff, but Irvine has been pretty much, hasn't been caught into that. So we're lucky here.
I am very glad about that. Okay, well, we have something really interesting to talk about. So you wrote an article for us about a shadow Fed president and this idea that, you know, Trump can get his way on interest rates without like throwing everything into craziness by firing Powell. So let's talk about that. What does a shadow Fed president mean?
So obviously, by the time this comes out, Jobs Friday would be here. And labor over inflation over everything. But, you know, when we're thinking about what's going on in the next few months, the GDP data came out this week, and it had the highest negative correlation through imports, right? Like negative 4.83%. You know, everyone was just buying ahead of the tariffs. So it really messed up the GDP. But if you look at real net consumption, like the Fed looks, they're like, hey, it's fine. It's been running at 3% for like 2 years now. So that's something that they track when they think about is the economy really breaking or not. But as you could all see, everybody's anticipating weakness to come around in a few months. So President Trump can't really fire Powell without going into the legal courts, and it's too long and, you know, sends a bad message. But the concept of, you know, obviously the 10-year yield, as I am talking to you right now, is at 4.17. And this is Wednesday morning. President Trump believes that if he has lower energy prices, a lower dollar, and lower interest rates, he has time to handle this trade war tap dance. And obviously, even though the 10-year yield is so much lower than what it was at the peak of the year, and we're seeing some benefits to that in the housing data, he just wants a lot lower rates because it gives him more wiggle room. And somebody brought up the notion, you know, China's 10-year yield is, you know, 1.63 or something that very nature. Their economy is a mess. Trump would love to have that. He would love to. Oh my God! If you told him, "Hey, do you want a 1.63% 10-year yield?" He's like, "Oh yeah, get it." Bassett would be dancing, you know, with wolves out there. He'd be so happy. So the White House would be ecstatic. But what if, let's just say hypothetical, the next few months things start to get worse, and the labor data starts to break? Why does President Trump want rate cuts? He wants to get ahead of anything bad. But he can't really fire Powell, and, you know, the quarterly GDP inflation data was a little bit stronger, and, you know, we're going back to even if there was no trade war, the Fed would probably be doing its same thing. We need more confidence. They weren't. There's 2 rate cuts at most with no tariffs, you know.
Right.
But what about the shadow Fed president, which is a concept that was brought in October with Bassett? And this would basically mean that whoever X is going to be the next Fed president. So we have a series of people that could possibly be the next Fed president. But X is now number 1 on the list. He is going to take the Fed president. And he's basically going on TV every day and saying, oh, by the way, we're going to cut rates aggressively. As soon as I'm in, you know, we're going to get very dovish. And in that sense, it's a shadow Fed president talking forward guidance to the marketplace that this is Powell's legacy and we don't want it. And as soon as I come into the job, we're going to cut rates. And Bassett was hopeful that that can take forward guidance lower and take the 10-year yield down lower and the Fed funds rate eventually without waiting for the labor market to break. That's why I brought up the shadow Fed president, because I saw a post saying, does the U.S. really want a 1.63% 10-year yield? I was like, oh, yeah, Trump will take it in a second, because he feels that he can handle this trade situation with lower rates, lower energy prices, and a lower dollar. Two of the three he has. The third, quite not as much. And also the spreads got hit a little bit here, too. So it costs us about 20 to 25 basis points on mortgage rates. But he feels like that would be a win-win for him.
So my question is, when you and I were talking about this concept, so first of all, it was Treasury Secretary Bessent who put this forward in the fall, right? And so I mean, it's an actual plan that they might use. But my question is like, is it too soon to do a shadow Fed president? Because when it's 2026 that Powell's term is up, if you start doing that now, do they really have any power, or the fact that they're saying what they're going to do front runs it enough that they do?
Bessent brought this up in October before Trump won, before
Okay.
he was going to be Treasury Secretary. If Trump could fire Powell and get 2% rate cuts today, he would do it in a second, no hesitation. So this would be a tactical risk of having someone who's going to be the next Fed president basically override the current one. But it would have to be market guidance that this is going to happen, and then you assume that the data is going to get worse and you want to get ahead of it. Or if the data gets worse, there's no reason why Powell and them wouldn't cut rates. Now, if Powell didn't cut rates, then they're going to do parades with this guy on TV all the time. Hey, I'm cutting rates. I'm just wait till I get in, guys. Don't worry. That becomes a little bit chaotic, I think, in that sense. Waller's already talked about, hey, we want to front load rate cuts. Michelle Bowman has said, hey, listen, I'm labor over inflation. But in this case, let's just assume that the worst happens. You start to get labor data breaking and the Fed doesn't get aggressive. We could see that shadow Fed president this year. Because I would imagine Trump would be livid, and he can't do anything, but he can do this. So I put this out here just for something, because when it was brought about last October, nobody kind of took it seriously. But now we're trying to figure out, the consumption data and GDP was fine, right? And the Fed uses that as their base model. Outside of jobless claims and job openings, that's kind of like their thing. So I think that's the only other trick in the bag that's left, right? Powell will be done next year. Pretty much probably not going to say, or let's just do a hypothetical. Let's just say that, oh my God, Powell starts to get really dovish, starts massively cutting rates, doing all these other things that the Fed could do to help the economy. And then all of a sudden Trump loves him again. And like he did in COVID, Trump praised Powell's response during COVID. So a lot of moving parts here, but it's just something to think about as people are watching this. The jobs data is out today, and again, the job openings data was fine; it wasn't anything great. The labor data we always want to keep an eye on wage growth and how jobless claims are doing. So you always want to take the aggregate. The ADP report missed estimates, and you go with that trend, but if they start whiffing on these jobless claims numbers and it starts heading higher, the Fed, if they believe they're dual mandate, has to get ahead of the curve. So if Powell doesn't do that, but some of the Fed presidents do, shadow president has some internal civil war people with him. That's why we talked about that about 2 weeks ago, that you already start to get dissents in this, how to deal with if the labor market does break, to go early. But I would imagine if that's the case, that shadow Fed president comes in more and more, gets more vocal about things.
Such an interesting idea. Don't you think, though, that, I mean, I know that Powell, really prizes his independence, but surely if he has some labor data that gives him cover, isn't he going to cut rates? I mean, wouldn't he want to?
He should, but you never know in this situation because honestly, he should based on the own Fed paper, right? Because they
Right.
said they don't want to kind of follow through with one-time tariffs. I think the issue is here is that if deals are going to be made, then there's no reason not to like aggressively cut if things get worse.
Trade
But
deals.
if they believe that there's no deals that are ever going to happen, then how would you reconcile long-term inflation expectations staying stuck for a period of time? So if they had the answer to that, if they knew deals were going to be made and things were going to get a lot better quickly, which everyone assumes, so the bond market is acting like that. Market is priced in 4 rate cuts already for 2025. So he'd have to go through. I mean, it's a setup for Trump where I think he would take it in a second. Hey, shadow Fed president, go be my bulldog out there and go after Powell. So it all depends on what the labor data does and how Fed reacts to that. And obviously, the first 4 months, everything was still somewhat intact in terms of consumption, and that's one of the reasons I talked about that today. Why does Trump want lower rates? Because in a domestic economy where everything's based on domestic consumption, that's the one variable that could come in and hit. If we were like an exporting country where our economy revolves around exports, that's a different equation. We're not. We're domestic. So lower rates, more disposable income, or more purchasing power in that sense. We've seen some benefits to that in housing so far this year, but I think that's if we're going in this area, we're going to start seeing that in the next few months and how the Fed reacts to the upcoming data.
Yeah, the interesting thing will be to see what happens as, shelves get empty and, container ships don't come in. We're just at the very beginning of that stage. So we don't really know what that even looks like.
Trump saw how the U.S. Defeated COVID. We had shortages, we had inflation, economy was booming. So, I mean, it was fast growth, fast rebound, everything, slow rates. That's what he's living off of. So in his mind, he says, I can handle this. I just need rates lower. If you keep it as simple as that, it starts to make sense. Lower energy prices, lower rates, the dollar's weaker. So in a sense, you can maybe export, but the whole 10-year yield and Fed funds rate is the one thing that's just not there for him. It's comfortable enough, at least.
Well, let's focus a little bit down into the housing market, right? So when this comes out, it's going to be May 2nd already. Crazy. So we are in a definitely the spring home buying season. Do you consider it done by May, or is it the end of May?
Well, the interesting aspect is pending home sales came in as a big beat. Like it's one of the biggest month-to-month beats in recent history. Just remember percentages, people. It's like existing home sales, we were looking for sales to decline month to month and be a tad above 4 million, which February's data was stronger. But because the percentage was like 5.9%, you had people out there saying, oh my God, it's the worst month to month sales crash percentage wise since 2009. Sales trends are basically all positive above 4 million this year. So pending home sales beat, it was a big beat from estimates. But if you read the tracker, everyone, you guys all know this, right? Our weekly tracker, all this stuff is kind of ahead of the NAR and everything else. So we keep everyone versed. So it's not shocking to us. But in this context, some people could over-exaggerate the positive data as much as they over-exaggerate on the negative data. So what do we know by now? Usually every single year in the last decade, I would say you kind of track purchase application data from the second week of January to the first week of May. The first week of May, you get a really good idea of what the forward-looking demand is for the year because traditionally speaking, after May, total volumes always fall. Now, COVID has messed up a lot of things, and we're typically now starting to see seasonal demand curves in November and December now, which we've never seen before. And It just reaffirmed that last year because purchase application data was growing even though rates were rising. And if you believe in the seasonal demand curve, there's so many people coming in at this certain amount of time that it could override even higher rates. But here, it's crazy to say this, Wheeler, 13 consecutive weeks of positive year-over-year data on purchase.
Crazy.
We're all like, okay. I haven't been able to say that in a while. The year-over-year data is, of course, very low on that context. So what we want to think about is the weekly data is still slightly positive versus slightly negative. But because last year mortgage rates went from 6.63 to 7.5, we had 14 negative prints, 2 flats, 2 positives only, and we had no positive year-over-year growth, 0. Here, as we're going in, to April, to this period of time where rates peaked last year, it's a different story. It's a much different story, and even though you have positive year growth, it's really just kind of a couple 100,000 home sales. You add that with purchase application data for the builders, which the last one, they have a monthly report. They don't have a weekly report, but that was showing 5% year-over-year growth and 14% month-over-month. That was for the month of March. You could get near 5 million total home sales again in the last decade from 2010 to 2019, right? The peak during that period of time was near 6 million. So you're missing roughly 1 million mortgage buyers, but you're doing this with elevated rates. The easy answer is sub 6% mortgage rates gets you a lot more home sales, but we don't have policy for that yet. But as you can imagine, they like the headlines trumpet them that purchase demand is up, pending home sales are up, even with elevated rates. Imagine if rates got down to 6%, they could run with that, right? They wanted lower gas prices. They wanted Bassett said, we want to unfreeze the housing market. We were heading, oh my God, we had such a nice curve in the 10-year yield and there was no volatility and purchase apps were up 15%, I think at one point year over year. And then the trade war, Godzilla tariffs came in and all volatility, and the volatility is boosted the spreads a little bit. So a positive year. Who would have thought that out of all the crazy data, the housing data would have outperformed estimates? But this is with elevated rates. See, that's the difference. If mortgage rates were 6% to 6.64, I'd say, oh, yeah, that looks about right. But it's doing it with elevated rates, and we always highlight this. Every year, wages grow. Every year, more people create jobs. Every year, households form dual household incomes. When you're working from the lowest levels, it doesn't take much to move the needle. And this is a really good example of it because we're doing this with rates that are above 6.64%, which normally we wouldn't really get a positive demand curve outside of the pure seasonal November and Decembers that we've seen in the last few years.
When you talk about that 6 million, right, from 2010 and 2019, and you think about 1 million missing home buyers, but that's a missing home buyers for several years in a row. So again, we come back to there is this pent up demand, which I know you don't love talking about that, but I think just from your own numbers, it's true.
I hate the pent up demand housing theory because I always thought it was a marketing gimmick. But because home sales are so depressed and these people are not dead, they're there, right? So if they had died, then I get it. If they were taken away by an alien, I get it. If they jump into a lava pit and are in some Godzilla King Kong world, I get it. But they didn't. They're still here. So because of that, and because of new home sales is still at 2019 levels, there's sub 6% mortgage rate. You just put the variables in there together. You have the potential for more sales to grow in that kind of environment, but it's been so long. This is the 4th calendar year of the lowest home sales ever because the crash really happened in the second half of 2022. So we had those elevated sale levels in the first part of the year. But if you look at that, we just basically hovered around that 4 million. And remember, the funny story is in 2020 during COVID, a lot of people hated me because we did the COVID-19 recovery model and everybody was like, oh, there's no way it's going to happen. This is all, the economy is going to fall apart. And I remember telling people that the purchase application data is up like 30% year over year. We're going to have positive home sales. in 2020. I never got so much hate for something like that because these people were so angry. You have to realize something. If your country is coming back from a COVID and you're hating the US, there's something wrong with you, man. You need to go to the Arkham's Asylum or something. You're cuckoo. Here he is. We're making this historic comeback. And I'm saying, oh, hey, home sales are going to be positive. And they're like, no, they're not. The US is in a recession. I said, no, the forward-looking demand's positive. This is why you have to track forward-looking demand. Guess what? We were actually up 300,000 home sales that year. It finally happened, but people were just not, they couldn't conceive that to be the case, even though the data was telling it. Here we have a little bit of growth on the purchase application, nothing spectacular. And it could be a couple 100,000 more home sales out there. But it is interesting that I always stress to people, if people just follow the tracker data and all the variables we put in it, you would be up to date more than 99.9% of the people out there. Because those people are crazy. Those people are absolutely crazy. This was a really bad week for like the home price crash doom people by the fact it's literally May 2025, whatever garbage they were saying for years didn't happen. But pending home sales, fine. Purchase apps held up, right? The growth rate has slowed down a lot with the rates going higher, but it's holding. Just imagine 6. You just head down there and stay there. 5.75 to 6.25. I can't really go below 5.75 until the Fed changes, but man, not bad. Not bad considering, right? Taxes, insurance, everything.
Right.
That 4 million level held. And that's why we always highlight that, because in 2020, we said 4 million. It's really hard to go below that. Here, the last 2 years, we've had a few monthly prints below 4 million. We've had a few monthly prints above, but we've never really broken under 4 million on existing home sales. If that was the case, everything changes. Like if existing home sales went from 4 to 2 million, the whole model breaks unbelievably. So it was a theory that we brought in November of 2022 that if sales get down to 4 million, you could find that stable level. We found that stable level for a few years now. And just like the 1980s, if you just get lower rates, 1980s, 2.5% lower rates, sales went up. Eventually it was down 5%, but oh my God, affordability was worse there. Inventory was higher. We had 2 recessions, right? Sarah Wheeler, you and I have talked about this a few times. If confidence was the issue, then people wouldn't be applying for mortgages. Everyone keeps on telling me the trade war is good. If that's the case, mortgage purchase application data would be down 20%, right? But something is keeping these people from, they're still applying. Why? Because millions and millions of people buy homes every year. We're from very low depressed levels. Mortgage rates are down a little bit this year compared to last year. There we are. The comps are going to get a little bit harder going out, especially the second half of the year, especially on the pricing. The month of October pricing is going to be probably negative year over year just because that was strong in our data lines. But hey, it's not bad. It's not bad considering what people were expecting.
I mean, I would say the consumer confidence is really bad right now. So I know you're talking about confidence for people to buy homes, but that has to filter into it at some point.
It is, but also if you look at consumer confidence, the domestic sales levels held up fine, right? So people are still spending. I get why people are nervous because of all these crazy headlines, but they're still spending. This is why Trump wants lower rates. Yes. He saw this. He saw COVID. COVID was, oh my God, confidence is, we're all going to die. And we're going to be in a depression. Literally, it was the sharpest rebound in history. We're Americans. We spend. This is what we do.
This is what
70% of domestic. This is what we do. So you can see why he wants low rates, but you can see here that we've had this discussion. Will the trade war headlines prevent people from buying? So far, 13 consecutive prints. Not bad.
Well, fingers crossed. I would wish it for our industry. We need some volume coming through. So either lower rates or that pent-up demand comes through. But Logan, thank you so much for being on again. We will talk to you again in a few days.
Pleasure. And if I see like two squirrels fighting over a nut, and I know you got tornadoes, I'll take a picture and say, this is the drama that we have in Irvine, California. By the way, I love Irvine, California. I think it's the best city ever. I am so biased.
Haven't you been nicknamed the mayor of Irvine or
No,
something?
I like, there was the devil of Hell's Kitchen. I'm the devil of the city of Irvine.
Does
And
that
by the
even
way, my high school basketball coach, like, God, I don't remember how long ago, 1993. He literally said, when it's all said and done, my name was Hossein back then. He said, Mohtashami, everyone's going to know him. He's like going to be the ambassador of Irvine.
the ambassador
Some
of
people,
Irvine?
we had a really smart group of kids on the basketball team. Like all these 4.0s are all going to come. But they said, when it's all said and done, he just has this thing that, you know, everyone will know how successful he is. He was right. Here we are.
Here we are. Okay, the
I
ambassador
have not changed since then, and it is. Oh, I love the city of Irvine.
You're doing the Lord's work as being the ambassador even today, saying that.
Yes.
All right. We will talk to you again soon. Hopefully no tornadoes here in between here and there. Thanks, Logan.